When China built a $200 million African Union headquarters in Addis Ababa as a gift, everyone applauded. 5 years later, a French newspaper, Le Monde, revealed that the building was secretly sending data to Shanghai every night. This single case encapsulates the complex reality of China's presence in Africa. Is China building Africa up, or binding it with invisible chains? With trade reaching $282 billion in 2022 and 25 economic zones established across 16 African countries, the scale of engagement is unprecedented. But behind the impressive numbers lies a relationship more complex than Western media portrays, and more important than many Africans think. What happens when a continent urgently needing infrastructure meets the world's most ambitious builder? A transformation visible from even satellite imagery. Africa's development trajectory has long been hampered by a critical infrastructure deficit that Western powers acknowledged but rarely addressed. Imagine trying to build an economy where reliable electricity remains a luxury, where roads wash away each rainy season, and where moving goods between neighboring countries can take weeks instead of hours. This infrastructure gap didn't materialize by accident. For decades, Western institutions labeled African infrastructure projects as high risk, with insufficient returns, creating a staggering annual funding shortfall of about $170 billion. Traditional development partners offered limited assistance, typically with stringent political conditions that many African governments found restrictive and reminiscent of colonial power dynamics. China's entrance into this vacuum represented a paradigm shift. Unlike Western partners demanding governance reforms before breaking ground, Beijing offered a pragmatic alternative: infrastructure now, with fewer questions about internal politics. This approach, while controversial in Western capitals, addressed an immediate need that African governments had prioritized for generations. The scale of this construction boom is unprecedented. Chinese companies have established dominance in Africa's construction sector, securing nearly half of all contracted projects across the continent. These aren't merely speculative ventures. They're transformative infrastructure works that Western investors consistently deemed too risky, despite their obvious necessity for economic development. Consider Kenya's standard gauge railway connecting Nairobi to the coastal city of Mombasa. This $3.6 billion project, completed in 2017, slashed travel time between Kenya's two largest economic hubs from a grueling 12-hour journey to just 4 hours. While debates continue about the project's financing structure and implementation challenges, the railway stands as physical proof of development progress that passengers experience daily. The railway represents just one node in a vast network being established across the continent. Chinese construction firms have laid down more than 6,000 kilometers of railways and 6,500 kilometers of roadways, while developing nearly 20 ports that have fundamentally reconfigured Africa's connectivity, both internally and with global markets. These aren't isolated projects, but components of a continental infrastructure web that facilitates commerce, mobility, and regional integration. A critical misrepresentation in discussions about China's infrastructure push concerns agency. Western narratives often portray African nations as passive recipients of Chinese-imposed projects. The reality reveals a dramatically different dynamic. African governments actively identify, prioritize, and request specific infrastructure developments under the Belt and Road Initiative. These projects emerge from bilateral negotiations where African states exercise considerable discretion in determining which infrastructure gaps need addressing first. The economic impact transcends physical structures. Chinese infrastructure investments have become a foundational element of Africa's industrial growth, contributing significantly to the continent's annual industrial output of approximately $500 billion. Nearly 12% of Africa's industrial production now traces back to infrastructure initially developed through Chinese partnerships. These aren't merely impressive statistics, but represent real factories, processing facilities, and production centers employing millions of Africans. By 2020, China had established 25 economic and trade cooperation zones across 16 African countries, attracting investments totaling $7.35 billion. These created industrial clusters that benefited from reliable infrastructure, allowing African manufacturers to overcome long-standing productivity barriers. While international coverage fixates on potential debt concerns, a legitimate consideration, this singular focus often obscures the tangible daily benefits ordinary Africans experience. Reliable electricity means hospitals can operate life-saving equipment consistently. Modern roads reduce transportation costs for farmers getting produce to market. Efficient railways connect job seekers to employment opportunities previously unreachable. Urban centers with functioning infrastructure attract both domestic and international investment that generates employment. Chinese infrastructure financing predominantly targeted these fundamental development needs, with approximately 40% directed toward power generation and transmission, while another 30% addressed outdated transportation facilities. These investments filled the gaps that had historically constrained African economic growth. While roads and power plants address Africa's immediate infrastructure needs, a different kind of deficit emerges in the economic relationship with China. Despite being Africa's largest trading partner, the structure of this exchange remains stubbornly unbalanced. Africa exports what comes from the ground, while importing what comes from factories. This shift from European dependency to Chinese partnership represents both opportunity and peril for the continent's economic sovereignty. The numbers tell a concerning story beneath the diplomatic rhetoric of win-win cooperation. China maintains a $64.1 billion trade surplus with Africa as of 2023, a gap that continues to widen rather than narrow with time. This persistent imbalance raises fundamental questions about the nature of this partnership. Is it truly transformative, or merely reproducing colonial-era economic patterns with different players? A decade's worth of promises to support African industrialization has yielded little change in the underlying trade structure. African nations continue to export unprocessed resources while importing manufactured goods from Chinese factories. This pattern intensifies, rather than diminishes, Africa's historical position in the global economy as a supplier of raw materials rather than a producer of value-added products. The technology transfer problem compounds this imbalance. When Chinese companies undertake major projects across the continent, they typically bring not just their financing, but also their equipment, technical expertise, and even labor. Local populations often participate primarily as basic laborers rather than gaining the technical skills necessary for independent development. This approach creates immediate employment, but fails to build long-term capacity that would enable African nations to develop their own infrastructure in the future. Perhaps most troubling is the strategic fragmentation that characterizes Africa's approach to China. While Beijing operates from a cohesive Africa strategy established in 2006, African nations largely negotiate individually, significantly weakening their collective bargaining position. This disunity allows China to secure terms that might not be possible if facing a coordinated African position. African economists have increasingly advocated for the African Union to take a more central role in setting the overall direction for engagements with China, recognizing the power that comes with collective negotiation. The diplomatic framework of non-interference that China promotes presents another paradox. While the absence of governance-related conditions appears respectful of African sovereignty, this hands-off approach sometimes means overlooking governance issues that ultimately determine whether investments benefit the broader population or primarily enrich elites. Unlike Western aid, that often comes with democratic reforms attached, Chinese financing arrives without such demands, for better and worse. Zambia's experience serves as a particularly instructive case study in this complex relationship. Chinese investment provided an initial boost to the country's copper production, creating jobs and generating export revenue. However, when global commodity prices fell, Zambia found itself in a debt crisis that raised profound questions about economic sovereignty. The subsequent negotiations over debt restructuring highlighted the potential vulnerability of nations whose economic relationship with China becomes severely imbalanced. Yet some African nations have managed to navigate these waters more successfully than others. The distinguishing factor appears to be the presence of clear national development strategies and robust regulatory frameworks. Countries that approached China with well-defined priorities and protections for local interests have generally secured more favorable terms. Ethiopia, for instance, has insisted on joint ventures and knowledge transfer programs in its manufacturing partnerships, while Rwanda has leveraged Chinese investment while maintaining strict guidelines about local employment and business participation. The lesson emerging from these experiences is not that African nations should avoid Chinese partnerships, but rather that they must approach them strategically, with coordinated policies that maximize benefits while protecting sovereignty. The most successful African nations in this relationship haven't been those who simply accepted or rejected Chinese investment, but those who shaped it to serve their defined national interests. As we conclude our examination of China's role in Africa, we're left with a reality that defies the simplistic narratives often presented in global media. The challenge for African nations isn't whether to engage with China, but how to do so strategically within the broader context of great power competition that's reshaping our global order. African leaders now face their most pressing geopolitical task, leveraging relationships with China, the European Union, Russia, and the United States, while maintaining sovereignty. This requires a fundamental shift in approach. Rather than negotiating as individual nations, each with limited bargaining power, Africa's future success depends on collective engagement. African think tanks increasingly advocate for continent-wide negotiation strategies that establish a unified direction in dealings with Beijing and other global powers. This collective approach isn't merely theoretical. It represents Africa's path to transforming relationships from dependency to genuine partnership. The continent's destiny will ultimately be determined not by external powers or international commentary, but by African leadership's commitment to coordinated strategies that prioritize their citizens' interests above all else.